I think for the Fed next week, they've already kind of signaled what they're looking at, which is mainly global developments, and I think they've boxed themselves into moving. I think going forward, I think it's really neither consumer nor manufacturing. I think it's really the labor market, and the labor market has been surprisingly strong lately, or it hasn't lost any steam in spite of the fact that business investment has slowed. I think if the labor market holds in, then I think the Fed will take some comfort in that and not really get too bothered by the softness we're seeing in manufacturing.
I so want to dwell on your comment that they've boxed themselves into moving, because it's fascinating and a little troubling. But before we go down that road, let me ask you about business investment. It was down in the second quarter. We know this is a really important part of the economy. Was it down because of tariff issues and some of the stuff we've been discussing, Mike, or why was it down, and do you expect a rebound?
Well, I mean, we don't know exactly why it was down, but I think there is a lot of anecdotes and certainly theory that would suggest that uncertainty as it relates to trade policy should hold back capital spending. It didn't necessarily happen in categories that were necessarily the most trade-oriented, but I think it's reasonable to suspect that trade uncertainty is a major factor holding back CapEx. In terms of the forward-looking indicators, maybe we'll do a little better in the third quarter, as Larry Kudlow mentioned. The latest data on orders and shipments in June looked a little better, so perhaps we'll do slightly better in the third quarter. But that said, the surveys aren't suggesting there's going to be a huge rebound in CapEx anytime in the offing. I think the best thing we can hope for is just some return to moderate growth there.
Sure. So, Craig, let me bring you in on that note from the investor's point of view here. And you've been saying for months, stick with consumer discretionary. That's been validated here lately. Do you still stick with that sector? And what about industrials, given what we talked about in the business sector right now?
Well, across the board, we see stocks as about 12% below our estimate of fair value. So we would expect the market to be 12% higher a year from now. You're right, we have been overweighted consumer discretionary, and we still find good value there. So we're sticking with it.
And when you say good value, we've got all these names at all-time highs today: Starbucks, McDonald's, Yum Brands and the like. Are they showing you that their earnings are going to continue to grow?
Yes, a survey of analysts calls for earnings in the consumer discretionary sector to grow between 12 to 13% per year the next couple of years. So that can raise value, and we think prices will respond.
What about industrials? I know you like industrials and financials, and people might say that both of those areas look a little bit more challenged. Why do you think they're attractive?
Primarily good value, but there's some healthy earnings growth in industrials as well. So we're overweight them also.
All right. So, Steve, I've got Craig Callahan talking about positives in financials, industrials, consumer discretionary. I got Mike Feroli here saying business rebound is expected to, maybe rebound to some mod. Why is the Fed talking about the economy as if it's falling off a cliff right now?
Talking to me? I mean, I think that they have maybe it's a bit like an, what do you want to call it, an over-executed pirouette, where they pivoted but went a little bit too far. I mean, I get
it's like
moving.
In ice skating, they over-rotated on the triple axle.
That's what I'm talking about. And you know what happens when you do that? Sometimes you fall right on your bump, right? Okay, so when I think about it, I got the pivot to the hold. Kind of got that, lot of uncertainty. But then they went a little bit, an extra rotation there, back to the cut without waiting. I don't know if you remember, but about a month or so ago, I put up a thing called the road to the cut. And one of the big stops on the road to the cut was, first of all, the jobs number, and then the GDP number, and then it comes in higher than expected.
And they were on that road before we even got those numbers.
I mean, I think they have enough in there to rationalize this. They have the capital spending slowdown that they were afraid of. They have some of the deterioration in some of the like German and some of the other indicators that are out there to take an insurance cut. What my guess, and I'm going to see what Feroli thinks about this. I don't know if you have time to ask him, but here's my guess. Here's my guess. My guess is today's number colors Wednesday's guidance. They cut, but we're going to get a little less promise of more to come than we otherwise might have if the GDP had been stronger.